I did a video on Celsius a few months ago. A lot of you enjoyed it, and a lot of you have asked me for an update on earnings of Celsius. If I believe the stock right now is a buy, or maybe it's some kind of a value trap or a growth stock trap, or whatever you want to call it. Maybe it's still overvalued, but I'm personally very interested in the stock. I started selling some put options. I'd love to own it at the right price, and I'm going to tell you a little bit more. And what do I think about Celsius in general? The stock got killed. It's down 35%, actually 33% on the month, 35% year to date. This has been one of the best performing stocks over the last 5 years. The stock is still up 2,438%. It was up as high as 6,000%. I mean, absolutely stunning, very good company, amazing growth. Good management team, amazing marketing team that was able to take Celsius from a brand that like a 2% market share, and now it has 11 or a 12% market share in the United States. Absolutely stunning. A lot of you are familiar by Celsius. They market themselves as more of a healthier kind of energy drink with vitamin C and vitamin B and all the vitamins and all that stuff. So they market themselves as more of a sugar-free or clean and better, healthier energy drink for a lot of young people. They really like the Celsius stuff. You also have Red Bull and Monster. Monster has been suffering. The stock is down a lot, but Celsius is down much more. And the main reason why Celsius has been going down so much is because the growth is slowing down. And this is the worst thing that could happen to you if you're a growth company. You had massive growth, 45%, 46, 73%, 140%, 107%, 101%. Of course, this is unsustainable. I mean, anyone knows that stuff. So the growth has recently declined. As of the last quarter for Celsius, the revenue grew 23%. Earnings per share grew 65%. EBITDA grew 29%. So the company is still growing very high on earnings per share, 65, 70%. It used to grow 140, 150%. Revenue is now 23% after growing 100%. And they did have some challenges in many different things. Like in the first half in total, it's up 29%, but it's still much slower than it was when it was growing 100%. And now the stock, in my opinion, is being priced accordingly. It's now trading at 34 times earnings. And I posted this on Twitter that I believe 34 times earnings is fair for the growth. And the main counter argument was that how is Celsius going to grow? There's no way Celsius could sustain what the analysts are expecting of earnings per share between 33, 34, around 30, 33%. There's no way Celsius can sustain it for the next 5 years. Well, I believe it's very likely for two reasons. The first reason is this company is very smart. The management team is amazing. The marketing is amazing. And they were able to be extremely successful in the United States. From a 3.6% market share just 2 years ago to now an 11.5% market share out of nowhere. They're taking shares from legacy brands like Monster and like Red Bull, but especially Monster and a few other smaller brands, now from 3.6 to 11.5%. Now, if they were able to do it in the United States and have massive success with their marketing through influencers in many different places. If they were able to do it in the United States, why can't they do it internationally? Why can't they do it in Europe? Why can't they do it in UK? Why can't they do it in Australia, New Zealand, many different places? I just don't see why they can't actually do that stuff. And international expansion has just happened in 2024. It's only getting started. Canada, they just entered in January. UK, they just entered in April. I read also in April. Second half, they're going to start in Australia and in New Zealand and also in France, and they're starting to expand around the world. So this is how I believe Celsius is ultimately going to get the 30 to 35% EPS per share growth, or earnings per share growth, I should say, over the next 5 years versus 100%, mainly from international. International right now, again, it has barely begun, and it hasn't even begun in most countries, and they're still growing at 30%, and it only makes up 4.5% of their revenue. Out of 400 million, 19 million is around 4.5% of the revenue. So I believe international growth and sustainable growth of 20 to 25% in the United States should get them around 30% earnings per share over the next 5 years. And if the company is growing earnings per share, 30 to 35%, and now it's trading at 34 times earnings. This is around a one peg ratio, price to earnings growth. And in my experience, this is extremely cheap for a growth company. If you're buying a company at 30 times earnings or 34 and a growing 30, 34 times earnings, this is cheap for a growth company. Most growth companies, they trade twice the growth. And this one now, you're buying it at a peg ratio of one. And the main reason this is happening is because of the uncertainty around the revenue growth. When the revenue growth drops from 100% to 29%, the market starts to panic and it believes, why can't it drop to 5%? Why can't it drop to 15%? But my argument is it's not going to drop to that stuff because of international expansion. I mean, it's just only getting started. It hasn't even happened in most countries. It's just happening right now in the second half of 2024. And there's so many European countries and so many different places they can expand to by using their US success, by growing market share so rapidly and using the same model, the same strategy, the same campaign, but maybe a little bit more skewed to different cultures outside the United States. I just don't see why they cannot have the same success. And I don't see how they're not going to grow earnings per share 30, 35%, at least 25%. But if they grow around 30%, this is price to earnings growth of one. I mean, this is a very good price on Celsius. It's the lowest it has ever traded at. It traded as high as 471 times, which I don't believe it was accurate. But it was trading sometimes at 120, 130%, 130 times, I should say. Now at 34 times, the stock isn't expensive at all, and they have a good balance sheet with $903 million of cash and cash equivalent, and almost no long-term debt. It's mainly lease liabilities and deferred taxes, so not much in long-term debt. Good balance sheet, good management, and I think international expansion is key for them. So I personally believe Celsius at the stock could somewhat be of a buy. I mean, I just don't think the growth is gonna go much slower. It's possible, but if it does hold up, I would expect the return to be pretty close to the earnings per share. So if we don't have a multiple contraction, it remains at 34 times. And if we grow earnings per share, let's say 30%, I would expect pretty close to a 30% return annual on something like Celsius. So for me personally, I like it very much over here, and I'm selling put options at a little bit lower prices, and I like it very much, and I really like the stock, and I think the stock is a buy. But again, maybe we get surprised and they grow 15, 20% instead of 23 to 30%. Although I don't see it mainly through international expansion. And this is my opinion on Celsius. I like it very much. I hope you enjoyed it. Not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.